Derek, without a doubt, Italy in the moment is a hotspot in Europe, right? Because actually we have no idea if the budget comes in at 2%, in terms of the percentage to GDP, or 3%. The market is going to fall out of bed.
Right. I must say, this is one of the reasons why I think the downside for euro from here versus the dollar is pretty limited. I just think there's a lot priced here in terms of the risks. When you consider where we got to, we've been trading around 290, we dropped to 250, we're back up to 270-ish. If you go back to the existential risks in relation to Italy between 2011 and 2013, the spread averaged around 360 basis points. So that was like the worst periods of, we got higher, but on average, that's where we were. So, I think if we were to break above 300, investors are really going to have to start considering, the re-emergence of these existential risks. Whereas today we're trading up and down on a daily basis on whether or not we're going to have, slightly less than 2% GDP deficit, 2.5%, or maybe up to 3%. And I get Italy has debt problems, but I think from where we are now in terms of the spread levels, close to 300 basis points, I think, the risks are that some of this risk is going to go away and we're going to see some narrowing.
But ECB is still buying, right? So if ECB didn't buy, where would the spread between Italy and Germany be? And I guess, is there an issue that if Matteo Salvini decides to fight Europe on this, that he'll go a lot further and then make euro and euro acceptance, the essential of the next campaign?
Sure. Well, I would say, first of all, a part of the movement in the spread is the anticipation of the ECB ending its quantitative easing. So I think that is being priced in. History tells you all actions on quantitative easing is priced well before it actually starts to materialise. And I think that's now reflected in the Italian spread. I get there is risks. So I'm not saying we should go back to 100 basis points where we were before. But I just think at 300, we're at a very extreme level. And there's very little evidence today to suggest that even certainly La Liga or even Five Star are up for creating a very public clash with Brussels. They may be strategizing and saying, let's wait 12 months, let's wait a period of time, which I accept is a very plausible scenario. But from a financial markets perspective, if we're not going to get that relatively soon, markets are going to look back and go, well, if sentiment comes back for chasing yield, given where Italy is, I think there's a trade there in terms of some narrowing of that spread again.
Derek, are we still in an environment where everyone is chasing yield? Is that still the driver here, or have things turned around enough sufficiently that we're no longer searching for yield, but instead looking to preserve principal and avoid losses?
Yeah, it's a good question. And I kind of, when we look at dollar yen, we ask that question. And, the yen was the best performing currency in the month of August versus the US dollar. Just the yen and the Swiss franc were the two that gained versus the dollar, the rest weakened. So there is some evidence there of the traditional large current account surplus currencies performing well, but it is relatively modest. And of course, that's because we still haven't seen compelling evidence of convergence from EM to DM. And the best chart to show that is the S&P 500 year to date is up nearly 10%, while the MSCI Emerging Market Index is down nearly 10%. Again, I'm not convinced that divergence can be sustained. If EM gets worse, that's going to start filtering through into the US economy. And then I would say you get a correction in US markets. And if there is evidence then of the filtering into DM, then you could see the Japanese yen and the Swiss franc perform even better.
Derek, thanks so much. Derek Halpenny there of MUFG.